Welcome to PIMCO Pod. In this episode, we discuss why emerging market bonds are delivering the best risk-adjusted returns in fixed income and what it means for multi-asset portfolios in 2026. Stay tuned after the conclusion of the podcast for additional important information. The Credit Market Lens. Sharpe is back in emerging markets by Lotfi Karui. Emerging market EM assets have continued to perform well this year, despite geopolitical headwinds and a generally stronger U.S. dollar. After several years of structurally lower Sharpe ratios, a gauge of risk-adjusted return, the asset class has begun to recover. EM credit, in particular, has delivered one of the strongest risk-adjusted performances across fixed income over the past 2 years. The more interesting question, however, is no longer whether EM has been worth owning, but how to own it from here. Part of that outperformance reflects higher starting yields and the extra compensation investors demand for EM's higher volatility. But that is not the whole story. Year-to-date total returns, with those of a ratings-matched U.S. dollar high yield, USDHY, benchmark constructed to mirror the EMHY index's BBB and CCC rating weights. While EM debt is now mostly investment grade, here we are focusing on the HY component as an analytical exercise. Even on that basis, and even after stripping out duration, EM has outperformed USDHY. Relative value advantages of this significance can be a feature of maturing asset classes and tend to compress as that maturation progresses. For multi-asset fixed income investors, the more relevant question is what EM adds to a broader portfolio. By comparing ex-post annualized Sharpe ratios for portfolios with and without EM, starting from a baseline mix of 60% AG, 20% IG, and 20% HY, we then add EM external and local assets funded from HY and AG. We see that EM has lifted total returns without reducing return per unit of risk. A shifting opportunity. How durable is this EM recovery? On many metrics, this is not the EM fixed income universe of past cycles. The external vulnerabilities that defined earlier EM crises have given way to more common risks like domestic and fiscal considerations, which typically evolve more gradually. Deep local rates markets, often funded by domestic savings, have largely reduced the foreign exchange, FX, mismatch vulnerabilities that shaped the late 1990s. At the same time, many EM central banks strengthened their credibility after COVID by hiking interest rates ahead of the Federal Reserve and engineering soft landings for their economies. Taken together, these shifts argue for structurally lower risk premia than history would suggest and support EM fixed income's continued role in multi-asset portfolios. At the same time, the maturation that has compressed the beta opportunity is now widening the dispersion across issuers, sovereigns, and curves. From here, the forward Sharpe story is increasingly idiosyncratic. The same valuation constraints facing developed market DM credit portfolios also loom large in EM credit, shifting the opportunity set toward more selective situations. In local rates, as in G10, the repricing of the front end of yield curves after the Iran shock leaves room for some relief if tensions ease, particularly in high-yielding markets. But dispersion is likely to remain elevated given differing domestic macro fundamentals. Inflation, for example, is still rising in parts of EM, notably Asia, where policy remains accommodative and limits the scope for a sustained rally. By contrast, markets such as South Africa and Mexico, where policy is restrictive and inflation appears closer to peaking, look better positioned for more durable gains. Thank you for listening. That was The Credit Market Lens. Sharpe is back in emerging markets. For future insights, please follow us on your favorite podcast platform. This episode uses an AI-generated voice. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.